Yes, once again, you're welcome. We are again here back on our normal work. Be sure that students or other learners get what is required in financial accounts. We are still on financial accounts, as you can see from the blackboard. But this time, the question that we have has an element of the journal entries for the adjustments. So we have the question that says the following information relates to the business of Mela Enterprises for the year ending 31st March 2012. And they are telling us to ensure that later we provide journal entries for the adjustments. Journal entries for the adjustments. But when you look in that question, there is something new which has come in. And that new thing that has come in is provision for bad debts. For bad debts. We are having provision for bad debts in that question. And you can see it here. Provision for bad debts, 500,000. So whenever we have, what do we have to know? What are bad debts? Bad debts are just expenses incurred by the business. And in most cases, this one comes in when you sell goods which are called sales to people who have not paid you money, and these people are going to be debtors. So when they don't pay you, it will be a bad debt, and this bad debt is going to go to profit and loss account, which we call particularly here as our income statement. What about provision for bad debts? That though you are demanding money from these debtors, you hope that, assuming you are demanding 100,000 from the customers who are your debtors, you hope that out of the 100,000 that you are demanding, there might be other customers who may not be able to pay you. And that's why you provide a provision for them. That possibly I will not get 20,000. So you are providing a provision of 20,000, provision for bad debts, that out of 100,000 that you are demanding, you may not get 20,000. And therefore you are going to get here 80,000. Because it's not always common for all customers to pay you money when they have taken goods on credit. And that's why we have to provide for that provision, such that we don't overestimate our profits when actually we are not going to get the money. So we put that provision, that assuming this one does not pay us, let us provide that provision. And then we see that element of provision for bad debts, so 500,000. And when we come in the question, they are also telling us to add just additional provision for bad debts of 1% should be made on debtors. So that is what has also been put here. Then in the part 2, they are telling us to prepare an income statement and a balance sheet other than the above date. Already preparation of income statement and balance sheet we have always been doing them. So they are not very new to us. What is new now is the journal. How do we provide the journal entries for these adjustments? That the ones we want to see, how are we going to provide those journal entries? Is why we are going to put much efforts in this question. But the remaining part B, this one people can do it because we have always done it. And our income statement, it is prepared in the same principle and the same concept of accounting that we have been using. So today we are going to put much emphasis on the journal entries for the adjustments. They are telling us that adjustment number 1, closing stock was valued at 1,500,000. And then they are telling us additional provision for bad debts should be made on debtors. And you can see here later we have 500,000. They are telling us additional. That on top of 500 should even include there again extra 30,000 of sort of 1%. Then they are also telling us that of the rent paid, 100 relates to the April 2012. And remember our year ends on 31st of March 2012. But they are telling us of this rent paid, 100 relates to 2012. Now what does that mean? When we are preparing the income statement for the year 31st March 2020, and they are telling us 100 out of the rent that we have inside here, and that rent, when you look at it in the question here, we are seeing rent expense here. They are telling out of 700, there is 1 million which relates to April. That one simply means that there is rent advance in that rent. We can call it advance, prepayment, unused, unexpired. See, all those ones there, they are the same. Then they are telling us wages of 30 were accrued, that by the end of 31st March 2012, we had not yet paid 30,000 for rent. It means it's a current liability. Then provide for depreciation as follows. Motor vehicle, 20%. And you can see the value for motor vehicle, 7 million. And they are telling us equipment, 10% of cost per annum. That is for now, equipment. And equipment you can see 5 million. So we are going to provide that. So today's focus is going to be put mainly on how to make journal entries for these adjustments. The remaining, like income statement and balance sheet, you will be able to do it at your own time. And then we see how we do with that. Therefore, let us see how do we prepare the journal entries for that statement. So one thing is that we have to ensure that we write what is the name of the business. In this case, the name of the business is called, it's called Mela Enterprises. So we shall say Mela Enterprises Limited Journal entries. Now these journal entries for the month, for the year, we shall say journal entries as journal entries as at 31st March, like that. This is the debit side, and the figures are in shillings. This is the credit side, and the figures are also in shillings. So these other things, we shall have account titles or entries, or details, depending on what you wish to put there. Details. And we could now start from there. So, and these are the things that you are interested from Roman number 1 up to Roman number 5. How do you put them in entry? In journal entries here. They are telling us closing stock. When you look at the income statement, assuming you are saying trading profit and loss account, closing stock in most cases is put in the trading account. And when it is put in the trading account, so it means here we are going to have stock account where now when we call in the journal entries, we follow double entry. We must debit one account and also credit one account. And stock, because it is closing stock, in most cases when it is closing stock, it will have a lot of stock which is going to be, this is stock account. And stock being an asset, it's always going to have balance brought down on this side here, on the debit side. And therefore, when we move it from here to close, it means it will be going to trading account. Just like that on this side. So we are going to take it to trading account. And therefore, in this case, we shall now say we are going to debit stock account. We are going to debit stock account and credit. So here we shall say stock account and debit credit here trading account. And we rule like that. So 1,500,000 will be on this side. When we come on this side of stock, it will be here like that. In this case here, we don't provide narratives. No, because we are not doing neighbors. So that's how it's going to be. So we go on to which says additional provision for validates. And we know that provision are going to be on the credit side. But now they are saying we add on this. So if it's on the credit side, then it means what we are going to calculate, what is 1%. So it is 1 out of 100 times, because they are telling us should be made on the data. This one here. You go in the computer and look for the data. You have data and creditors. So 3 million represents the data times 3 million. 3 million. This one will go with that. So we have here 30,000. Just like that. So we have created our provision, additional 1% of the data. And in that case, provision for bad debt being put on this side, from the credit side, it means there we shall add it. Because from what we see there, it's like when you have provision for bad debt, and they are telling us that balance brought down here is 500,000. Just like that. And then they say additional, we have got this. So we are going to put here bad debts. Because when you increase, it means now we are increasing the charges of bad debts. That is like that, 30,000. And this one will go now to bad debts account. We are going to say bad debts account. And now because we are creating provision for bad debts, under double entry, it will come this one to say provision for bad debt 30,000. And therefore we can see here that we are going to debit bad debt account and credit provision for bad debts account. And therefore here we come and create that. So we are saying here we are going to say bad debts account and credit provision for bad debts account. By how much? The additional 1%, which is 30,000. So we shall put here 30, and also come here and put here 30,000. After that, we shall also close it like that. So that's that. We are creating journal entries for our adjustments. Then we got the next, which says of the rent paid 100,000 relates to April 2020. Sorry, 12. Out of the rent paid of 700, when you look at that rent there, it is like this rent account. And you will have here balance brought down, which is 700,000. Like that, that's how it is. And they are telling us that out of that amount of money, 700, there is 100, which which relates to April. But remember, this one ends on 31st March 2012. But the part of this 100 relates to April, the same year. So if you are preparing income statement for the year ending 30th of March, 31st of March, then this one for April means that it was prepaid in the year 2012 by 31st March. So how do you do that? And you know that when it is prepaid, it becomes an asset. And therefore here, what we are going to do here, it means the part of this we are going to be moved from here to go to prepaid. To go to prepaid rent. And they are telling us it is 100. Such that we remove it from the rent account by putting that prepaid. And then we come to prepaid rent account. Because it's for prepaid. And we shall put it here as 100,000. So you can see that we are removing it from the rent account and taking it to prepaid rent account by creating the rent account. And then when we go to prepaid rent account, we shall debit it. It's like when we are preparing the income statement, we have always seen where we said less operating expenses. We always write and say rent 700,000. Like that before. 700,000, yes. But because we have rent prepaid, we have always said that when it is prepaid, we do what? We say less prepaid, rent of 100,000. Such that here we remain with the rent for that year to be 600,000. And you can see the same thing here. When we balance this account here we're going to have a balance carried down 600,000. When we add this side, you get 100 plus 600, you get 700. Even here 700. And then we shall get the balance carried down, which is here, to come on this side, on the rent account, to be balance brought down 700,000. Sorry, 600,000, which gives us like this. In the income statement, this is how it will be prepared. So we have already moved the rent, which is prepaid. And remove it, we are saying we shall now debit the rent prepaid account and credit the rent account. Just like that. So here we are saying that here we're going to have prepaid, sorry for this, prepaid rent account, which is here. Remember here we start with an account which we are going to debit, but not the account we are going to credit. That's why we are beginning. This one is here account of rent up and this one here down. But when we are recording getting the journal entries, we begin with the account that we are going to debit first. And you can see we are debiting prepaid rent by 100,000, and then come this one to say rent account, which we have debit crediting by 100,000, like that. And then we close that account too. Then next is wages. Do you have the wages? Yes. Wages account. You can see here wages. There's a wages of 100,000 were accrued. How have you been treating accrued in the income statement? How have you been creating? Because we know accrued expenses which are accrued are liabilities. And because they are liabilities, so we have to treat them in the balance sheet as liabilities and a current liability. So what we have here, they are telling us that wages of 30,000 are accrued. And you can see we have wages in this account. When I check, wages, these wages, you have wages somewhere. which we have, I didn't put it there, but we have wages. I must have missed. Yes, it is there. Salaries and wages, they put them together. Salaries and wages, they put them together. Yes, that one's okay. They are telling us 30,000 is accrued. There, it's like salaries and wages, like this. And we have here balance brought down of 1,530,000. So we know very well that in the income statement, we have always been preparing your income statement where we have less operating expenses and saying salaries and wages would say 1,530,000. And you know very well, if they are accrued, we say add accrued wages. Here like this, 30,000. So that here we can get 1,560,000 as the amount of salary and wages. Therefore, if we have wages of that accrued, what are we going to put here? So here we shall just say salaries, wages accrued of 30, we are going to add it there, and then we open up wages accrued salary, wages accrued account or accrued wages account. And because we are debiting the salaries and wages account, here it will be credited by 30,000. So we are going to debit the salaries and wages account and credit the salaries and wages accrued account. Just like that. So in this case, we shall come here after closing that and debit salaries and wages account by 30,000 and credit accrued salaries and wages account by 30,000, and then close that part. So though here they are telling us this only wages, but when we go to the trial balance, they combine them. That's why here we are also combining them, because you cannot be able to separate the two here. You don't know how much were the salaries and how much were the wages. So when we are opening up the accounts here, we shall just add, that combine them the way they are there. Next, let us go to motor vehicle. Is to be depreciated by 20%. And we know what we mean by depreciation. Loss in value of fixed assets except the land. So how are we going to treat that? You just calculate. Depreciation for the value of the motor vehicle, which is 20%, that's 20 out of 100 times the value for motor vehicle of 7 million. 7 million, like that. This one goes with this one goes with it. 2 times 7 is 14. How many zeros? 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. Which is 1,400,000. So we are going to treat this and say depreciation of the motor vehicle and accumulated depreciation. So we are going to, because depreciation here is an asset, so we are going to say depreciation account of the motor vehicle or motor van, 1,400,000, and then we come here and say accumulated depreciation for motor vehicle account, which is 1,400,000. You close that. We go to equipment and cost. Still the same thing, like you have done under motor vehicle. Per annum, 20%. The value for equipment, you can see them there, 5 million. So we shall also do the same and get 10% times the value for equipment, 5 million. This one here. So this will go with this. And here we have 10 times 50,000, which is how many zeros? 1, 2, 3, 4, 5. So we have 5, 1, 2, 3, 4, 5, which is 500. And it is the same thing. Depreciation of equipment account, depreciation account here of equipment, and credit accumulated depreciation account of equipment by the figure we have got 500 here, and even here 500, and we close of that account. So that is how it is going to be, and that is where our journal entries for this part ends. But remember, when you look in the question, say from the journal entries, prepare an income statement and then the balance sheet. But like I said in the beginning, this part B is we have always done it, and therefore this one you will be able to prepare them. My major focus was on how do we create journal entries and see that those entries are recorded. These adjustments are recorded in journal entry. This part remaining is very easy. So you have to prepare income statement, and then prepare the balance sheet. It will come up. Remember, by the end of it all, when you are preparing the balance sheet, you have to ensure that the balance sheet agrees. The side of assets must be on the side of liabilities. And if it does not agree, it means you have made some mistake somewhere. It can be a mistake, it can be an error. These are common errors. Thank you for that part. The remaining part, try it on your own and see how you can get that. Thank you very much.